Everyone, welcome to the weekly market update. I'm Gordon Scott. We're going to take you through a couple of things that are going on in the stock market, in the U.S. stock market right now, and with a little word of how it should or could have an impact on currency markets as well. So right now, the main thing about the U.S. stock market is it's back to break even as of just this weekend, or just the last couple of trading sessions. The U.S. stock market has hit the prices that it was at the very beginning of the year. So starting from 2025, it's recovered from all of the craziness that people have been worrying about. And let's see if I can keep that. Okay, and it's actually just a little bit above. I'm going to try and share my screen and show you how that all works. Let's see if I can. There we go. And apologize, give me a second. Should be coming up about now. Hopefully you can see that screen now. Thank you, Sam, for the feedback. Okay, so what I'm looking at here, this line represents where the market opened in the first day of trading for 2025. And you notice an interesting thing. On Tuesday, it went up, touched that line, came back down a little. Wednesday, it had some sort of, back and forth. And then we've got Thursday, and then Friday. Notice how when it went down, it came down and touched this line, but then closed up. All right, let me zoom in on that and make sure you see this. So this is kind of that, yet another example of that resistance becomes support principle. I don't know if you've heard of that, but if you ever see some particular level of resistance, if the price breaks through and then turns around and acts like it holds, that's an important reverse of polarity. I've heard it described that way, but it's important because then that tells you the forecast is bullish. That if we get up here and we stop and keep bumping against that line, then that resistance persists, and you could say, well, it's not very bullish. There's a lot of people that want to be sellers. But if it just blows right through that line, and even better, if it sort of retests after getting through and then keeps going higher, that's generally very bullish, and that seems to be where we are right now. With the S&P 500 using SPY as our measure, which is the most heavily traded ETF out there. If we use the index SPX, it shouldn't be too much different. So I haven't marked it from that line. Let me see if I can just make sure that I'm not telling you craziness. Yeah, 2nd of January. That's the opening print right there. And yeah, same kind of thing. It's got that resistance, and now it is support, and we're up and off the line. So where next? Well, probably it's going to go make a new high. Is it going to go straight up and make the new high? I doubt that. You'd expect a little fluctuation, but the reality is that it has run up off the bottom tremendously fast. And because it has moved that fast, coming up off of this crazy bottom, I mean, this is all about, the whole tariff news, Trump tariff news. And people thought, oh, it's going to create markets it's going to create a recession. It's going to create instability. It's going to negative, negative, negative. You heard a lot of that in the press. And now all of a sudden, people seem to have changed their mind. Here's the thing to really pay attention to. If you're not familiar with this principle, in the stock market, it's very important and very repeatable that you see this. When you see a big downturn like that, the thing you want to see to know that, hey, it's done, we're not going to go back and hit new lows, is a change of volatility. And in this case, we saw that, right? There were even, starting right there in the middle of December, even before people really got super concerned about tariffs, then we saw these larger candles. You see, before that, as candles are going up, you see a couple of big ones, but a lot of these small ones right here, right? And all of a sudden this big one happens, and every candle going forward, on average, not all exactly, right, but every candle on average has a larger range. And then all of a sudden we get down here and these huge candles. Now, so right through here, we're coming up fast, but the candle height is still pretty high compared to this, right? Then we get these tiny small candles here. When we started coming up off of this, I was a little skeptical. I thought, I don't know, is market going to turn around and go back down? But then right in through here, I thought, it's not going to come back down. Now's the time to step on the gas and be a buyer. And this past week we saw smaller ranges. They're still not quite like these tiny little ranges here, but they are significantly smaller than what we've seen going back there. If in fact you were to put some numbers to that, you would use the average true range. And the average true range is just measuring, that average distance between the high and the low, including the gaps. And then through here we got this huge, but we've come back down. And this includes that line right there includes the last 14 days. So the big slide right through there shows that declining volatility. And on average, we still haven't made it below where we were before all the craziness happened. So there's more to go. But the fact that we're this low tells me we're probably not about to, turn around and go down and make a new low, that sort of thing. If in fact we were, surely, hitting that line and hitting some resistance on that line would have been what we expect. So that's the surest indicator, hitting that line and going right through. That's the surest indicator that we're not in a bearish mood, at least not yet. And the fact that we've got smaller ranges happening is a confirmation of that. And if you needed more confirmation, then we've got this thing, VIX. The volatility index has to do with option prices. And you can see it is way down here. We're just about to, we've matched, we're just about to take out the lowest, swing low from back in March. And that's a very good sign, very bullish sign. That number 17, that's still pretty high, for something that is a bullish market, right? But you can see it's coming down from a pretty high peak. And, when we're in this sort of, hey, we're going up and we just don't care kind of market, then we're usually down here below 15. That area right there, what do we got? 15. Just, right at 15. We have been above 15 all year, and a lot of volatility, a lot of uncertainty in the markets through here. But the fact that we're coming down here, if we go and we make a new high, then of course you would expect to see us probably make it all the way down there back below 15 again. All right. So one thing I like to do is compare the old highs, right, and say, or sorry, the old lows on the VIX and the old highs on the S&P 500. So if we look at the March 25th period and say, where is the high there on S&P 500? And this low right here is the 14th of February. So let's just look at what those should be. Those dates should be significant highs on the S&P 500, right? And so we see this one here, the 25th of March, and then the other one there, 14th of February. So they're close. They're not exactly the same, but they're close. The VIX's low was right here, and the other low on the VIX was right there. So this is the kind of high point. But we're way past this high point. So keep this in mind. We're way past this high point on March, but we're at about the same level as the VIX, which means there are still people holding on to a little nervousness, a little uncertainty. Like, what's going on here? Why is the market, working its way up to higher levels if people are just as nervous as they were right here after this, first big initial push, and then sort of a bear, what they call a bull trap, a bearish, fake out, kind of on the way down. So what's going on there, right? Well, it might be that there are a lot of people who still feel like we're, going to make a big downward turn. I came across something that really gave me pause yesterday. I decided to research it. All this past week I've been looking into it, but I decided to look at this much more closely. Let me show this to you because I felt, as I was cycling through all my stocks and was looking for trade ideas to, add to my own portfolio and figure out, what am I going to do for the next trade to make, I came across this idea of doing a put option on Berkshire Hathaway, selling short Warren Buffett, right? And the reason I thought about doing a put option there is this candle on Wednesday was the lowest close from way back here. But as I started looking at the chart, I thought, this is really interesting, really unusual that we see the rest of the market down and just getting back up to break even. But Berkshire Hathaway, it is not, looking at break even. It's been in positive territory, for the whole year. If you start at the beginning of the year there, it's been in very positive territory, up around 18% at its high. And right now it's sitting at 12, 13 almost percent gain from the beginning of the year. And when the market had this huge volatility dropping down, 12, 14% or so, it dropped, but just that's all it did. This, from there, it's a huge drop, but it never even went negative for the year. And I thought, wow, Warren Buffett just must be picking the best stocks out there, right? Let's look a little closer here. So I went and looked up, based on the 13F, that's the filing that every hedge fund has to do to, say, here's what we're holding. And they have to do it once a quarter, and they have to publicly announce it. Now, the public announcement comes like in a month lag at the latest. And so by the time it gets out, that's what his portfolio was a month previously. Well, Warren Buffett doesn't, buy and sell rapidly. So it must be the case that if he's telling you, well, this is my portfolio as of a month ago, it's probably still his portfolio right now, or very close to it, right? And I was really shocked by what I saw. The portfolio includes about 20 positions, I want to say, and 20-ish, maybe. Anyway, the top 8 positions in the portfolio account for 86% of the portfolio. So if you just sort of add up all the stocks and you put them in to the portfolio, or put them into an equation, then you can track what the portfolio is pretty much doing. And so I did that. Now, in fact, Apple is 25% of the portfolio, and American Express is 8% of the portfolio, and Coca-Cola is 7%, and Bank of America is 7%, and Chevron is 6%, and so on and so forth. And so I just did all the math to say, okay, how much influence on the portfolio does Apple have compared to others, and so forth. And so I actually tried to create a portfolio where what Warren Buffett is holding is tracked like a stock, and put it on the screen compared to Berkshire Hathaway. Okay, so here it is. I'm going to show that to you now. Oh, yeah, sorry, I need to... I don't know if I dare do that. I think what I got to do is... See these scales right now. Oh, that's how I can do it. Change that to percent, and that is already percent. So great. So this is what the portfolio looks like, but it isn't. No, if I change that back to regular and then move it down, that's how we're going to do it. There we go. All right. And we'll change that to regular. So here's the thing. The value of Warren Buffett's portfolio, yeah, you're seeing this right. I was aghast, right? Like, here has the value of Warren Buffett's stock, his company's stock. And here's the value of the portfolio he's holding. It goes way down, and it comes back up, right? So now I gotta like squish this whole thing so I can put it together on the screen a little better for you. There. All right. So the value of Apple and American Express and Coca-Cola and all the others in terms of what the well, just if he sold it today, if he had bought it at the beginning of the portfolio or at the beginning of the year in January, and he sold it today, he would be losing money. He would have bought it at this indexed price here, 276,629, right? And then he would have to sell it. If he had to sell it today, he would have to sell it at 264. Now, this number doesn't really mean anything specific. It's just the math I used to track the performance. But you can see that the value of his holdings are way down. His stock is not being held up because what he holds is so valuable. It's being held up for some other reason. Well, the reason that, hey, people anticipate that it's going to keep going higher. People want to hold his stock because they think, well, he knows what he's doing. Now, he is currently holding a cash value that is something like over 320 billion. I'm going to zoom out way out here and show 10 years of this data. Now this isn't exactly his portfolio. This line here is not 10 years of his portfolio. It's not even 10 years. That's there we go. Okay, and this one there. Because, it changed. It changed all over the years, right? But if I were to take these stocks that he's holding in his portfolio now and go back and track them against, the biggest one is Apple. Berkshire Hathaway has held a huge chunk of Apple for many years. And so if I were to say, pretend he held all the stocks that he's holding right now in the same proportions he had all the way back to 2017, then what do we get, right? That is sorry, what it would look like here on this chart that I'm showing you right now. So the big question is, how is the value of Warren Buffett's company compared to his portfolio is, historically related? What does it look like? Does it matter? Does it go all over the place, right? I'm going to use this thing called the correlation coefficient to try to, let's see, actually to make this work right, I'm going to have to put the portfolio in the main place. There we go. And then we'll hide that and we'll bring up Berkshire as a comparison. There we go. And then we'll say correlation coefficient of BRK.B. All right. Now this is the main thing I want to show you here. The correlation between Berkshire's value, the value of its holdings, and the price of its stock, are they correlated? And I'm going to use a window, a mathematical look-back factor of 62 days because that is a quarter, one quarter. And what we see is, yes, it is. So 1.0 means it's totally correlated. It means it's acting like it's basically the same thing. 0 means it's uncorrelated. -1 means it's totally inversely correlated, right? So you can see here from this chart that most of the time, this thing is higher than 0. In fact, it's even higher than 50, right? It spends most of the time more correlated than not. And if you go back here and you look at the bottom of these moments where it is below 0, then we look at those and say, what happens at that time? And here, now, in this case, Berkshire is now the green line, and the portfolio is the other line. So you can see from the bottom here, this one, Berkshire, went up significantly higher. From the bottom of this one, Berkshire went down. From the bottom of this one, Berkshire kind of goes sideways. From the bottom of this one, Berkshire goes up very significantly. But this one here, where it goes, it comes way down below 0. From the bottom, what do? Well, this one, Berkshire goes down a little bit. Not a ton, but a little bit. From this one, Berkshire goes down a lot. But of course, that's 2022, and a lot of stocks went down at that point. How about here? This one, Berkshire goes up. This one, Berkshire goes down a good bit. But again, it is late 2023. Yeah, I wouldn't say that was a time when stocks went down. That was actually a pretty bullish time. So anyway, right through here, Berkshire goes down from this extreme low point. And then now where are we? Here's the thing that just really shocks me. Look how much of a divergence this is. And you can see that since the beginning of the year, this whole correlation has taken a completely different character from what we're seeing now. Big old drop. it's kind of come back up. This is the value of the portfolio, and that's acting kind of like the market. But Berkshire Hathaway is up. So this massive disparity between Warren Buffett's holdings and the price of his stock. And so the reason for that, don't know, but I think one potential is the fact that he has this huge cash position. So like 30% of his holdings are cash. He's never had more, as a percentage of his portfolio, he's never had so much cash before, ever. So again, the candles are his portfolio and the line is his stock on this chart. So it's a little change from what I was showing before. But as you can see, this huge disparity here. I think on one level, that is investors saying, we're really nervous about the markets, but we trust Warren Buffett. So we're going to just shove our money there and hope he knows what he's doing, because we can't figure out the markets, right? I think there's part of it that is that. Now I need to show you another chart of McDonald's. We're kind of having a funny little thing happen here, and I mean, it's not funny to investors who are holding these stocks, but in the U.S. we're having a little bit of a restaurant company recession. McDonald's came out and said same-store sales are 3% down from what they were last year. And that doesn't sound like much, like, oh, they lost 3%. Huh? So what's the big deal? It's actually a very big deal. Not that the 3% is huge, but when you consider the effect of inflation and the prices. In other words, McDonald's raised, they increased their prices on their food, on their menu items, a good bit this past year. So they should be making more money because their stuff's more expensive. So if they sold the same amount of stuff, they should have something like a 5% increase or more on same-store sales. But instead, they have a 3% decrease. So you put these things together, and in relative terms, they're down 8%. In terms of sales, they're selling 8% less in total food amounts or whatever. 8% less customer experience, or 8% from, well, okay, I think you get the idea. The point is, their stock shouldn't be up, but it is. Like Warren Buffett, people are trusting in McDonald's. See, there's the beginning of the year with McDonald's, and they're up strongly, right? And what percentage are they up? They're up like 14% on this year so far, 14%, and yet their same-store sales are down 3%. Well, okay, you could say they're just doing better in terms of profit, right? Maybe they're making so much more profit even though they're not making as much money. Well, here's what they released in their earnings. They're down 2.38%. Same-store sales are a subset of that, right? So being off 2.3%, that doesn't sound like a whole lot, but that matches what the same-store sales numbers was. But here's the profit margin. Profit margin increased by not even 0.1%. Profit margin is about the same. So are they making a ton more money? No, they're not. Are they making 14% more money? So they're not even making 14. That number was almost 10. Are they making 10% more? No, not anywhere close. Why are investors buying McDonald's up like that, right? Well, famously, it is. Um, Famously, it is that they are a real estate company, not a food company. That's what people would say. It's like, well, McDonald's is in the real estate business. Okay, let's go with that. So I'm going to add XLRE. This is the commercial real estate industry ETF. How does McDonald's compare to that? Well, uh, McDonald's is way ahead of the commercial industry. Yeah, commercial real estate industry doesn't look negative for the year, but it doesn't look 10% positive. So people are even more optimistic on McDonald's than they should be, even taking real estate into account. So I think what we have is a scared market. People are, I don't know what to do. I don't know what to buy. I'm just going to put my money with the stuff I trust, right? So here's the problem. If anything pokes that bubble, so to speak, anybody says, no, it's a bad market. Get your money out of the stock market. If people somehow believe they need to get their money out of the stock market, then yeah, all that money that's in McDonald's, all that money that's in Berkshire Hathaway and other places, that could just come out really fast, right? I think that some people believe that's going to happen, and that's why you have the VIX elevated. I mean, when I say some people, I'm not talking about people like you and I, individuals. I'm talking about people who are hedge fund managers, who are big fund managers, professional institutional money managers. I believe that some of them are worried that a big crash is coming. Most aren't, though. Most still have their money in the markets, and that's why we're running up and hitting new highs. Okay. Now, in order for us to think that the stock market really has the ability to go up and make new highs, then I think the biggest problem that people would have to overcome is this idea that the tariff wars, the trade wars, we're gonna get past all of that. You'd have to be able to believe that somehow they're going to get resolved soon. The issues are going to get resolved soon, and things are going to get back to. I don't know if they're going to ever get back to normal. Nowadays, what is normal, right? But comfortable enough, predictable enough that you don't have to be afraid of investing. So the thing to do there is for us to look at the currency markets. So I'm going to check out, starting with the euro. When the tariff stuff got going, and we'll go ahead and hide the Warren Buffett portfolio there. When the tariff concerns got going, then here you see the euro just really took off because people were thinking, oh, Donald Trump's going to screw up the U.S. economy. He doesn't know what he's doing. Let's get our money out of the dollar. And getting it out of the dollar means usually just the flip side is the euro, right? So if it gets out of the dollar, then we get into the euro. But I think it was more than that. I think we had actually a lot of European investors who had to pull their money out of the U.S. because they were now getting slapped with such high tariffs, or the threat of such high tariffs, that people just sort of repatriated. A lot of the European investors repatriated their money back into the euro. And so I think that was driving a lot of that move up. That being said, what's happened since the bottom of the U.S. stock market? If I put the stock market right over the top of this, why didn't that go? There we are. So here's the U.S. stock market. And as you can see, the big slide begins to happen. And right from this point, the euro starts climbing. But now, as we've come up out of the bottom very strongly, what's happened with the euro? The euro's falling. So we're in this world where you've got markets coming down, and or sorry, dollar market, the euro and the dollar coming down, and the U.S. market going up, and vice versa. So the euro and the U.S. market are inversely correlated right now, and I think that will continue for a little while longer. The first big change, though, was the UK trade deal. And as other countries end up making trade deals with the US, I think that this correlation will begin to break apart. But it's still there. It's still there fairly strongly. So as long as the US market's going to continue to go higher, the euro is probably going to go lower. This little trend that's gotten started is likely to continue on lower. So if you're a Forex investor, I'm not saying, sell short the euro and just write it down. You never do that. Here's the thing, okay. For anybody out there who's concerned because they've been struggling with Forex, or think of it this way. Stock markets, regardless of which market, but particularly the U.S., they are a trending market. They tend to move very strongly in a direction. But Forex markets tend to revert to the mean. If they move strongly in one direction, they're going to come back. That's an important way to be thinking about it. If I were to, and I don't have too much time, but here's the thing. You need to find ways where you can trade on the Forex markets in reversion, as opposed to holding on to a trend, getting onto a trend and holding, especially if you're especially if you're trading the euro. The US dollar Japanese yen pair is a little more of a trending market. And you notice this has a completely different look to it. This one looks a lot more like the US stock market than the euro does. So it's generally trending down, but with the US stock market heading up, we'll probably eventually see the US dollar start rising compared to the yen. And we'll see the euro falling compared to the US dollar. That's my expectation, because the markets are still strong. Yes, they're very nervous. We don't know which way they're going. But if you do think I'm going to trade in terms of a reversion instead of like hold on and just ride the trend, then what you're going to do is you say, on the euro USD, I'm going to look for opportunities to sell. If it gets a little high, I'm going to sell it down. I'm going to just tilt my trades towards that direction. If in fact I were buying, working with the US dollar and the Japanese yen, I would want to be a buyer. I'd want to look for dips that I could buy, even down in the hourly time frame. You would just favor the stuff, favor the kinds of trades, the kinds of setups that would go whatever direction the U.S. stock market was going. In the case of U.S. dollar, Japanese yen. In the case of euro, it's going to be the opposite. Okay, so that's where we sit. We've got a market which is just a little crazy in terms of putting money in. It's overvalued. It's an overvalued market, but people have a lot of money and they can't find better places to put it, so they put it there and in the places where they have the most amount of trust. And right now, that's stuff like McDonald's or Berkshire Hathaway. It's a funny market. I myself am actually interested in trying to look at technology stocks. I have not bought NVIDIA. I'm not quite ready to go there yet. But Tesla, I've done pretty well being a buyer on Tesla. I was a buyer here and I set a price target there, and I took my profits already because it hit the price target. And now I'm waiting for it to sort of pull back, take a little dip, and we'll try again. That's one of the stocks I'm keeping an eye on. Micron really has done well. I've profited from this move. AMD is another one that also seems to be doing well. I mean, now it's sort of pulling back, but that's its start of the year. It's not all the way there yet, but it's come up so rapidly. I fully expect that it will make it there and continue to go higher. So those are technology stocks, chip stocks even, and yet they're kind of doing well. I don't know, maybe that'll change, but where we are with the market update is we've got people that want to be buyers in U.S. stocks, and you can use that to make whatever decisions you feel are appropriate.